Hello and welcome to the UBP podcast. My name is Peter Kinsella, Global Head of Foreign Exchange Strategy. And today I'm joined by Thomas Christiansen, our Senior EM Portfolio Manager, and by Koon, Chow, our Senior EM Analyst. And today we're going to discuss the EM 2020 outlook. So Koon, we'll get started. What in your view, in your macro scenario, what's changed from 2019 going into 2020?
I think what's important is that going into 2020, we'll be looking at a less problematic exports trend. Some of the PMI numbers in emerging markets have been bottoming out, and that's already starting to feed through into export numbers here and there. And also you've seen some indicators that some countries are being able to sell a little bit more. Asia is doing a little less badly. They're benefiting from tech sales globally, which seem to have been bottoming out. And that's all helping. And I think as we go into next year, we'll probably see these confidence indicators from stronger PMI translate to a little bit better exports, industrial production, and we may get growth at an aggregate level in the emerging market stabilize or even improve a little bit. I think that's going to be quite helpful for emerging markets because for the first half of next year, there's a lot of intransparency for the second half, but for the first half of next year at least, we could be even have a period where EM growth picks up a little bit relative to DM because we were first into the downturn, and with a wider gap between EM and DM growth, you can get capital being sucked into emerging markets, portfolio flows being sucked into emerging markets, and I think that could be helpful for EM assets, EM fixed income.
Okay, that's pretty interesting outlook. So, given that change in outlook, Thomas, what do you want to own in EM coming to 2020?
Yeah, so I mean, with that relatively constructive backdrop, I think what you want to own is within the sovereign space, at least certainly the high yielding portion. I mean, the scenario that Koon outlines, which is reasonably constructive on growth, and indeed potentially growing growth gap between emerging and developed markets, that tends to be the kind of environment that favors spread tightening. And so, what we see is obviously there's a lot of more room for spread tightening in the high yield space than there is in the investment grade space. Currently the sovereign investment grade average spread is around 150 basis points, where high yield is around 530 basis points. And that leaves IG sort of towards the 5-year tights, whereas the high yield portion is sort of somewhere around average. I think also interesting to note in this context, for the last 2 years, 2018 and 2019, for very different reasons, but these 2 years investment grade has outperformed high yield within the emerging sovereign space by around 4% in 2018, around 5.5% in 2019. Now that's relatively rare. I would say that probably happens around once every 4 years on average. And indeed, the 3 years preceding 2018, high yield tended to outperform investment grade by around 5% per year. And so I think you have a relatively interesting backdrop for emerging markets. And the other thing I would highlight, I mean, Koon points to potential for sucking in capital flows. I would say in the second half of this year, flows have been somewhat mixed, but in Q4, relatively constructive inflows into emerging market debt. And now we couple that with around $55 billion worth of coupon and principal repayments in the first 4 months of next year between January and April. And so if you have 55 billion returned to investors, and also on top of that, the potential for inflows, that could be relatively constructive, which would also again tend to lead to spread tightening.
So, given that we have this kind of broad, nice scenario where spreads are tightening, where global economy is doing reasonably better, or we're seeing some better growth outlooks. What are the risks of this scenario in your view, Koon?
I think there's a couple. I mean, from our perspective, how trade evolves globally. At the moment, it looks like that the US and the Chinese are still talking, but it's been a very volatile set of discussions. If we end up in a period where we're back into high tension between China and the US, then this tentative improvement in business confidence in EM could be shaken. And then we could be talking about only a temporary increase in activity.
And what about you, Thomas? What do you think are the main risks?
Yeah, I mean, Koon points to I guess one very obvious one. Now, one that I think is maybe quite a lot less likely, but indeed, if we are even too cautious on growth, and we actually see such a significant growth pickup that it starts to threaten that inflation is coming back to some larger extent than what sort of most people are expecting. Certainly if you were to start trying to price Fed hikes and so forth, and see a steepening curve, obviously as a fixed income asset class, that could throw us off course a little bit. I mean, I think Powell's been relatively clear the bar to cutting is relatively high, but the bar to hiking is even higher. But if you were to start seeing numbers that would suggest we might exceed that, that's another risk worth bearing in mind.
Okay, and I guess really from my perspective, if we look at EM and we think of the currency outlook, and it seems to be that we're likely to get a broadly weaker dollar next year, given that growth isn't doing an awful lot in the States, modestly lower growth, with inflation not really doing an awful lot thus far, although there are some risks, of course, to both the upside and downside. But our base case would be to see a broadly weaker dollar, which is normally consistent or correlates well with EM currencies doing well. That said, from our perspective, we think the one or two currencies we like a lot in EM space are the Russian ruble and the Mexican peso, just reflecting the very, very strong real interest rate profile, very decent balance of payments framework, and of course any decent pickup in growth in either country will be very well received by investors. Elsewhere, we've seen that in 2019, EM currencies, more broadly speaking, kind of illustrated a much higher correlation with CNH and Chinese renminbi rather than with US Treasury moves, which kind of suggests that we're still really at risk of sort of trade rhetoric, be that being dialed up or dialed down in 2020. So the Trump G factor hasn't gone away for EM FX yet, and it's likely to stay with us for a while yet.
No, absolutely, and I think unless we see a firm resolution to that, which I don't think we will in the trade side, then it's going to be hard for us to say, look, the economic outlook for beyond the next 6 months for China is going to be clear. We can't say that, and therefore we won't be able to say, well, the worst is over for the renminbi. It's going to be still quite difficult.
Indeed, I quite agree. Well, thank you very much for listening, and we look forward to coming up with another podcast in the coming weeks and months. Thank you.